This video will explain a few easy ways to adjust the risk profile and break-even range of calendar and diagonal spreads. 1 week ago, when Costco was trading at 150.5, we showed what a hypothetical portfolio would look like if we bought calendar spreads at the 150 and 155 strike prices. This is what the risk profile graph looked like at that time. Our maximum profit range was between 150 and 155. Our break-even range was from 147 all the way up to 158. Lo and behold, 1 week later, we're already up at the 158 upper end of the break-even range. This is a great opportunity to show how adjustments can be made when the stock fluctuates more than you would like. It also shows the biggest shortcoming of trading calendar spreads. You just don't like volatility. In this case, we got volatility in a big way. Stock has gone from 150.5 to 158. That's more than 5% in a single week. We now have reached the upper end of the break-even range. Normally, you would have made adjustments well before that, but let's show what we can do even though we waited so long to make the adjustments. The key to making adjustments to calendar spreads when the stock moves higher is to move the short calls to higher strikes. In this case, we will sell the calendar spread we originally bought at the 150 strike and replace it with a calendar spread at the 160 price. So we'll take this 150 off, sell a calendar 5 times. We're selling the Aprils, and we're going to sell them for $4.45. If you recall, we paid $4.70 to buy that spread, so we're actually going to be losing money on it. We're selling it for a little less than we paid for it. On the other hand, the calendar spread we bought at the 155 strike, we paid $4.34, and that would cost $4.60 to buy now. So the portfolio itself hasn't really lost very much money, just a little bit, in the 1 week while the volatility was much higher than we thought it would be. So now let's buy a new spread at the 160 strike. Buy the calendar. We're going to go out to April again. Do 5 of these. We're paying $4.82 for this one. It's a little bit more. So let's look at the risk profile graph now. Now, with the stock price right about 158, our maximum profit ranges from 150 to 160. However, our potential profit, is now down under $800. Now we've got invested about a little less than $5,000 in this investment in these hypothetical spreads. So we're not making a whole lot of money. We were hoping to get 20 to 25%, and this is quite a bit less than that. This is maybe about 15%. So there are other things that we can do to make adjustments. One way I like to do is to roll up the short 155 calls that we have to a higher strike. So let's buy a vertical spread, and we will buy the 155 strike, and we will sell at the 157.5 strike. Again, we'll do all 5 of them. This means we're going to have to cough up a little money, $1.72 per spread. So we're going to have to be putting in almost $1,000 more money than we started with. However, we look at the risk profile graph now, and instead of making about $800, our potential profit is up around $1,100, and our break-even range extends for about $3 on the downside and $5 on the upside. I'm still not totally happy with this. If I had some more money, I would buy an additional calendar spread up at the 165 strike. However, I like our chances here, and I'll be ready to adjust again if the stock starts threatening getting up to this upper end of the break-even range. Of course, it may fall back, and we'd have to adjust to the downside. But I feel strongly about the stock, and would probably resist making adjustments if it fell in the short term on the downside. But I would expand on the upside. Let's look at what our actual Terry's Tips Costco portfolio looks like, because we adjusted in this portfolio. I'll take out all these adjustments that we just made here. Okay, our portfolio is actually going to expire. Our short-term option is going to expire a week from today, next Friday. So you can see this is a $7,000 portfolio now. It's picked up a little bit money since last week, and in 1 week our potential gain is $1,300 if the stock stays right where it is now at 158. If it falls, if it goes up $5, we're going to be making only $534. So again, if it goes up this far, halfway to the upper end of the break-even range, we would make another adjustment. But you can see that we're looking at a potential 15% gain in a single week with this portfolio, because we made adjustments on our existing portfolio, the real portfolio. We wouldn't have waited until it got way to the end of the break-even range before we made that adjustment. This concludes our discussion of a couple of ways you can make adjustments to calendar spreads. In the next video, I will discuss a different kind of adjustment strategy that we use at Terry's Tips. Our strategy is more of a tweaking procedure that avoids big adjustments, such as taking off a calendar spread and replacing it with another. See you next time.